Now, let's move on to some of the risks that the UK faces. Julian, what are the risks facing the UK in your portfolio?
Well, I think there's perhaps no risk by extrapolation. So most people would say that there are macroeconomic risks. But of course, we've actually seen the stock market performing very well, almost despite what's been going on in the economy. So I'll say it again, that the UK economy and the stock market are very different. Nonetheless, at extremes, obviously that is a risk. And I think you would also put geopolitics into that as well. But overall, I mean, it's long been the case that valuation tends to override all of these factors. So when valuation is as attractive as it is for the market, that tends to override most of these other things. Of course, the real risks are often things you can't really predict, COVID, something like that. So one always has to be aware that could be around the corner. But in terms of the risks that we can identify, we think valuation should overcome those.
Okay, well, that's hopeful. We're so attractively valued that hopefully people will be investing with us. Thomas, what do you think of the risks?
Yeah, if you have a think about the balance sheet within any economy, you've got different types of debt that builds up over time. And obviously, if those of all of us here remember very well the build-up of private sector debt. So individuals were taking on lots of mortgage debt. Do you remember in about 2006, 2007, and then that all subsided? We've got a very different problem now. It's not so much that consumers have got lots of debt, it's that governments have got lots of debt. And that's beginning to ripple right across the UK stock market. So you're seeing the effect. In fact, I've noticed every meeting I've had has had some version of that discussion, that actually the government is running out of cash. We all remember that note in 11 Downing Street that was left for the incoming coalition government back in 2010, which said, there is no money, the cupboard is bare. And that's even more the case now. So actually that will affect lots and lots of different companies. The Chancellor has left it to the last minute to do her budget. She's going to have to find out how she can raise money. And the problem for her is that raising tax rates doesn't always mean raising tax revenues. So we've got to think ahead a bit, and we've got to work out, look, who's going to be under pressure post that budget. And actually going back to the point I made earlier, you know what, we have to find stocks which are cheap, but they can't be value traps. They've got to have catalysts. And so if we can find stocks that are cheap, that aren't necessarily going to be affected. So we're thinking about stocks like Galliford Try, that actually there's a lot of private sector investment in areas like water, which don't depend on the government, the indebtedness coming good anytime soon. So that's where we see the opportunities.
Excellent. Wow, yes, I can see we've got to really think harder here in terms of where those opportunities really lie in this difficult environment. Ian, what about you? What do you think the risks are?
Let me give you a non-macro one, which is, I think that one of the big risks is basically a bursting of the US technology bubble. US technology stocks have gone up a long, long way for a long, long time. They now represent a third of the S&P 500. They are, as we all know, investing gargantuan amounts of money in AI with, for the moment, nothing to show for it. And investors have been willing to give them the benefit of the doubt. There's a risk, I think, at some stage that actually investors begin to get a little bit wary of this. They watch the cash burn of these companies, and eventually these share prices roll over. Now, the sort of short-term risk, if you want to call it to that, is that if these things roll over, they're going to take everything down with it. The rest of the world stock markets are not going to sit there in splendid isolation as the US, as the Nasdaq goes down. I suppose the positive side is that actually, number one, the UK market is much, much cheaper than the S&P 500. So you would imagine that it would hold up better. And then number two, it might actually encourage people to think about reallocating money. So for a number of years, people really have seen particularly in the US, have seen no sense of diversifying. Just having 100% of your equity exposure to the US has been the right way to be for a long period of time. If we saw the US technology sector roll over, well, maybe people might start to question that, and the UK might end up being a beneficiary of that.